Good morning to all the attendees. This is Pranav Rao from Smartkarma's research team again, and I'm delighted to introduce Charles Macgregor, the head of Asia at Lucror Analytics. Lucror is an independent research provider specializing in European, LatAm, and Asian corporate high yield. Lucror was established in September 2010. Charles has over 37 years experience in financial markets encompassing accounting, auditing, taxation, insolvency, corporate and commercial bank risk and credit management, corporate ratings, buy-side fixed income portfolio management, and fixed income research. Charles has a Bachelor of Economics from the University of Sydney and a Master's of Applied Finance from Macquarie University. He's also a Fellow of the Chartered Accountants of Australia and New Zealand. Charles, over to you for your presentation.
Okay, thanks Pranav for the introduction. A little bit more information about Lucror Analytics. As Pranav said, we've been around for 10 years now, celebrating our 10th year of operation in 2020. Lucror is an independent credit research firm, and it's 100% owned by management. We currently have 16 analysts, 8 of whom have over 20 years of experience and backgrounds in rating agencies, buy-side, sell-side, and auditing firms primarily. We currently cover about 400 names across Asia, Latin America, and Europe. All right, I'll commence the presentation. What I'd like to do today is to give you a sense as to what's happening with Asian high yield at the moment. And I'll start off by giving you an overview of the construct of the Lucror Asia High Yield Index, give you a sense as to what it's all about. Next, we'll focus on index returns recently from the major emerging market and high yield indices. Then we'll look at option adjusted spreads, which obviously spiked in March, and we'll compare that where they are now as to where they've been trending over the last 10 or so years. Then we'll come in and have a look at Lucror credit bias and how that's trended over the last couple of years and what our outlook is on that particular measurement. And then talk about the current state of play as far as what are the risks at the moment to investment, what are some of the challenges that we're seeing out there in the environment. Touch in on prospective emerging market default forecasts and get a sense as to what they likely will be in the next year or two. And then lastly, present you with an investment thesis which we think is prudent in the current environment. Okay, start off with the index. This has been running since 2013. The amount of bonds outstanding at the moment is 240 billion. Back in 2013, it was about 90 billion. So the market's grown quite significantly in the last 7 years. More recently, in the last 3 to 4 years, there's been a lot of issuance. Last year, we saw 82 billion of issuance. This year to date, we've seen 25 billion of issuance already in January and February. Obviously, that's now stopped with the current crisis. The yield to worst on the index at the moment is very high at 11.6%. Option adjusted duration is quite low at 2.25 years. The option adjusted spread, 1,130 basis points around about there. And then the average rating of the index is B+. If we look at some of the constituents of the index, you'll see that by far the largest proportion of issuers are Chinese property companies. Now, they have a specific reason for wanting to go to the US dollar market, is that a holding company in Hong Kong will issue the US dollar bonds and it will then downstream them to the operating subsidiaries in China. Now, this is important for them because operating subsidiaries can only use equity to acquire land, and so the downstreaming of the US dollar as equity facilitates that ability. Obviously, from a credit perspective, the subordination risk is apparent, but that's why they like the US dollar market. The next largest group of issuers are the other Chinese companies that have 42 billion on issuance at present. Their reasons for going to the US dollar market may not be as obvious as the Chinese property companies. And in fact, for a number of the issuers, we wonder why they indeed are going to the US dollar market. We then move down and we see that India has 8% of bonds issued at 20 billion. A fair chunk of that is Vedanta. And then Indonesia has 6% or 13 billion, right? So the market is heavily skewed towards Chinese issuers, with 75% of outstandings, of which property makes up a major proportion. If we move now as to where they're actually trading in the market at the moment, so the market value of bonds issued is 223 billion. So that implies that they're currently trading at 93 cents in the dollar. Now, if we move through the various segments there, we can see that there is some difference between them. We go from one extreme, which is Hong Kong, where the bonds are trading at 100 cents in the dollar, and that reflects the fact that Hong Kong issuers tend to be unrated, and they've probably got a rating profile that's more akin to a triple B than, say, a double B. The Chinese property bonds, interestingly, are trading at 97 cents in the dollar and haven't been overly affected by events of the last couple of months. Certainly some high beta names like China Evergrande have been affected, but overall, you know, they're trading quite well, as we'll see later when we look at index returns. The outliers there are Indonesia and India. Now, there's probably more energy-related names in those two environments, and also in Indonesia, the property names have also been quite hard hit by the environment that we're in at the moment. They've had a couple of years of poor trading, and that's now caught up with them with the crisis that we're in at the moment. Okay. Next up, we have the returns on the indexes. Obviously, they crashed in March, the returns, but positively, we've seen in the last month that pretty well all of the various indices have come back relatively well. We note that the emerging market Asian high yield indices have recovered the best, coming back 4.2, 4.5% in the last month. If we look at returns over 5 years, this I think is a good point to make, is that the Bloomberg Barclays indices are returning between 10 and 20%. Their Asian high yield index is returning almost 21%. The Lucror Asia High Yield Index is returning 26%, and part of that is because it's got more of a weighting towards the Chinese property sector, and it doesn't include financials or sub-sovereign. If we look at the stellar performer there, it's Chinese property. That's the index that we've had going since 2013, and in the last 5 years, it's returned an incredible 44%. And also, if we just look quickly at the top line, and that's the Lucror model portfolio, which we commenced back in April 2013. The reason for that was that we wanted to have some sort of empirical evidence as to how well we are able to recommend individual bonds. And that model portfolio is constructed of 40 names that don't change greatly, maybe 1 or 2 each month. And over the last 5 years, as we see there, it's returned 38%. Okay. Auction-adjusted spreads, as we noted earlier, they spiked in March, initially due to pandemic concerns and also the collapse in the price of oil. But in the middle of March, they went up again as there was a general lack of liquidity in the marketplace. And so that meant that anybody selling was forced to take a lower price. Since then, we've seen them stabilise, especially in the last sort of 6 weeks. You know, they've been pretty much range bound in that period. And if we look at current spreads on the Asian high yield index, it's around about 1,130 basis points. Now that compares to the range over the last 7 years of 400 to 800. There have been peaks and troughs outside of that range, but generally that's where it's traded. The peak was 1,620 back in March. Lucror Asia High Yield Index wasn't in existence in 2008, so unfortunately we don't have a precedent there as to how high it might have been in that time. if we look at the Bloomberg Barclays indices, they all spiked, back in late 2008 at levels that are significantly above where they are at the moment. Those spikes were only for a couple of months and they came back relatively quickly. If we have a look at the range that they've been in for the last 7 years, interestingly, the Barclays EM index, the range has been around about the 200 to 500. So it's currently only trading about 60 basis points outside of that range. So, investors seem to be taking a more benign look at emerging market Asia than they are at particularly the high yield ones when it comes to where they were previously. The Euro high yield is about 150 basis points outside of its range, and likewise for the Barclays US high yield. Okay, credit biases. So we have a credit bias on all of the 400 names that we cover, and I track them on a quarter-to-quarter basis as to what the variance is there. Historically, it's been around about 15 to 20% has been the negative credit bias, but what we've seen in the last 3 quarters especially is that has increased. In fact, spiking in the current quarter to almost 50% of the names that we cover now have a negative credit bias. So that means that over the next 12 months, we expect there to be some deterioration in the credit profile. That said, I think the good news is that we've done a lot of work recently looking at all the names in our portfolios, and the sense that we get is that they're relatively well positioned with their current biases. So the names that we have as stable at the moment, we're not expecting those to move downwards, absent, I suppose, a prolonged pandemic effect and a significant period of time for economies to recover. All right, where are we at the moment? Obviously risks remain, they always do, but there are some positive signs starting to emerge. The bad news is that economic fundamentals really are quite horrific. And I've been around for a fair while, and I've never seen anything like this before. I think you have to go back 80 years to get the type of negative economic numbers that we've been seeing recently. For instance, the number that really scares me is unemployment in the US, where in the last, I think it's 7 weeks, 36 million people have registered for unemployment benefits. To me, that's a truly horrific number. It's very scary, and we'll get onto the equity markets in a minute. But other fundamentals are also quite negative there as far as GDP, PMIs, retail sales, motor vehicle sales, housing sales, they're all been negative. China, okay, nowhere near out of the woods yet, and we're definitely not expecting a V-shaped recovery there. But what we are seeing there is some recovery on the supply side, which has been a little bit quicker than expected. So the composite PMI was 53 in April. We saw industrial production was 4% up year over year in April. And exports, interestingly, were also up 4% year over year in April. We track property sales for the larger developers, 30 to 40 of them on a monthly basis. And what we've seen this year is that obviously January was poor with the Chinese New Year effect, and then the lockdown, and then February was very poor with the lockdown. But there's been a gradual recovery in March and April. And interestingly, if we look at individual companies on a trailing 12-month basis, we see the sales back at levels of around October, November last year. So the recovery's there. Some pressure on average selling prices, but once again, they're back at levels where they were in the middle of last year, which were quite high. So we're starting, as we see on the property side, we're starting to see some recovery there, and we're relatively confident about the outlook for that sector as far as not being very many defaults, especially among the larger. There might be 1 or 2 smaller niche players like Tahoe, that's a luxury home provider that could be under pressure, but the big guys like Country Garden, Long4, the like, we don't see any pressure there on those names. So China, there is some signs there, but still some ways to go. Obviously, the risk from an economic perspective is that the pandemic could linger longer than expected. The Fed chair came out last night on TV and said that it could take until the end of 2021 for there to be a reasonably full economic recovery, and that could well be dependent upon the development of a vaccine for the coronavirus. Okay, something that we think about a lot and is very concerning is the geopolitical issues that we're confronted with at the moment, specifically what I term as a US-Sino virtual war. Trade tensions have risen recently, probably because of the US's insistence on a greater investigation into the origin of the coronavirus. Anyway, that's just my personal view. We now have the US threatening to extend the conflict to financial markets, so restricting government funds from investing in certain Chinese securities, and that could be an issue for if it is extended. Okay, so in the last month or two, we've seen equity markets rising, which is somewhat counterintuitive when we look at the economic backdrop. They seem to be getting a lot of confidence from the large stimulus that's coming from central banks in Europe and the US. That said, we note that if we look at the S&P 500, roughly 25 to 30% of that index composition now is 5 FANG stocks: Facebook, Apple, Netflix, Google, and Amazon. And they're all, I think, pretty much back to the pre-crisis levels now, getting pretty close to that. So yes, equity markets are looking relatively strong, but part of that's related to a small number of stocks in my view. Okay, so the last point we've got here, and this is probably the one that's most important from a fixed income perspective, it is our understanding that fund managers do have surplus cash currently to deploy. Over the last basically month and a half, 2 months, there's been a shortage of issuance in Asia, and this is primarily because companies are just not prepared to issue at current rates. They're prepared to sit it out. A lot of companies have pre-funded over the last year, and so the apparent need for most of them is relatively low. At the margin, though, there are a number of smaller issuers that have maturities coming up that will struggle, but and may have to issue at higher rates if they indeed can get access to the market. So what we're seeing is a pent-up in demand emerging. We saw last week a Chinese property company, Genro Properties, which is a high single B rated company, come to the market with a $200 million senior notes issue. They got that away at a yield of around about 8.5%. They had a similar issuance for a 2024 bond in January at a rate that's about 60 to 70 basis points lower than that. What was interesting from our perspective is that the book order for this issue was $1.4 billion. So 7 times oversubscribed, which indicates that yes, there is demand, and we expect to see more issuance coming forward soon. Okay, last I'd just like to, corporate default forecast, yeah, okay. Always difficult to predict given uncertain outlooks, but always interesting to think about. If we look back to one of the worst years in recent memory, it was 2009 when the default rate for emerging markets was 13%, quite high. Recently, 2 forecasts caught our eyes. One of them was the Moody's forecast, and they're looking at a number of around about 8% to 11% for 2020, and a number of a range of around about 8 to 14% for 2021. To put that in perspective, the default rate was 2.2% for emerging markets in 2009. So they're expecting, a 4 to 7 times spike in the rate from last year. The other forecast that caught our eye was JP Morgan, which is looking at 4.8% for 2020. Now, in our view, that we believe that the rate will be closer to JPM than Moody's. A number of reasons. If we compare 2020 to 2008, 2009, we think the composition of the emerging markets corporate index is much better than it was in 2008, 2009, primarily because there's a larger proponent of Chinese issuers in there, the property companies, and less Eastern European. To put that in perspective, I mean, China is an A+ rated country that's got a stable banking system. We saw in one of the earlier presentations today that I think there were 3 Chinese banks in the top 5 banks from an AT1 capital investment perspective. And so they've got more of a stable environment than a lot of the other EM places. So the fact that there's more China will put a bit of a break on that default rate, in our opinion. There's more stimulus happening than there was in 2009 in developed markets, and at the margin that will float through to the developed markets. Of interest this week is the Chinese National People's Congress, and there is an expectation that a stimulus package of some significance will come out of that, directed at health, technology, but more importantly from our perspective, infrastructure, which will flow through to a number of the larger urban property developers. We think that ratings are unlikely to experience the levels of downgrades they saw in 2008, 2009, which were quite significant. And part of that was that there had been an explosion in ratings between 2003 and 2006. And a lot of them were what I would have termed as being somewhat friendly. And so they weren't robust at all. So when the monetary crisis hit, there were significant downgrades at that time as that the agencies played catch up. If we look at where we are today, I think the ratings are more stable, much more stable than they were back in 2008, 2009, primarily because the agencies over the last 3 to 4 years have been downgrading quite a few ratings, and they're probably at levels now that I perceive to be a lot more robust. So while there will be some downgrades going forward, I'm not expecting there to be a significant number of what I would term precipitous or downgrades by 2 to 3 notches. Okay, so that's why our forecast is probably closer to 5% than it is to the Moody's numbers, which I don't know if they came up with those. They seem very precise. Okay, so lastly, I'd like to present to you a possible investment thesis, which we believe to be prudent in the current environment. One that investors, I think, that are concerned with the economic outlook, and that'd probably be everybody, may wish to consider a shorter duration bond strategy. Part of the reason, well, a major reason is that we perceive that shorter duration bond strategy will exhibit lower risks, lower credit spread and rate risk in volatile markets, so the movements won't be as extreme as they would be for a longer duration bond. To a degree, it enhances liquidity during periods of poor market technicals. And what we've seen in the last 12 years is that the dealers have lower inventory levels due to regulatory capital requirements now. And so their ability to come in and intermediate has been reduced at a time when the market size has increased quite significantly. And I said to you before that, just in the Asian high yield, we've gone from 90 billion back in 2013 to 240 billion outstanding now, at a time when dealer inventories have gone down. So we don't have that sort of stabilizing mechanism that we may have had in the past. And this is obviously going to be particularly in periods of rising credit risk, as we've seen at the moment. We saw back in March, around March 2021, 22, when there was a lack of liquidity in the market, that spreads spiked at that time. Having shorter duration bonds also provides you with a continuous stream of maturing funds, and this is helpful if you have redemptions. So rather than needing to be a forced seller, there's just this continual sort of roll-off of funds that you can be continuously investing in shorter duration bonds again. Now, next point is quite interesting. Provides a buffer against interest rate risk. We're in an extraordinarily low interest rate environment at the moment, and I suppose fixed income rate analysts are expecting that the possibility of negative rates in the next 3 to 6 months is 50% or better. So in the short term, it's there's no seeming upward pressure, but I counter that with the point that the Fed Reserve is going to be issuing somewhere in the order of 3 trillion of securities in the next 3 to 6 months. So intuitively, that will put upward pressure on rates. Transaction costs are reduced by holding bonds to maturity because you're not trading as often. Buying and selling, they mature. You don't pay a premium when they mature, and then you hopefully get into a new bond on issuance. Lastly, if we look specifically at Asian high yield in the context of this strategy, it's our belief that the spreads that we're currently seeing on Asian high yield, okay, the index is at 1127, 1130 basis points, around about there. That's providing almost 500 points pick up over European high yield and 400 over US high yield. So implicit in that spread at the moment is that the default rate for Asian will be 4 to 5% higher than it is for European or US high yield. Now, I struggle with that concept. If we look at one of the industries that's most at risk at the moment, it's the upstream oil producers. And within the Asian index, if we just exclude Vedanta, which is a little bit more diversified than a pure upstream player, but if we look at the rest of them, they're less than 1% of the index here, whereas in the US, it's 8 to 9%. So just looking at that one industry alone, I can't see how the Asian default rate is going to be 4% higher than US high yield. Finally, we would recommend that investors look at a BB rated Chinese property names, just because we perceive them to be more robust and stable. They have good systemic support with the banking system and the government stimulus package. And then lastly, just avoid single B Indonesian names at the moment. They will have trouble accessing capital markets, and some of them will struggle to refinance their US dollar bonds. That's the presentation for today. Thank you.
Thank you so much, Charles. I think we've unfortunately hit time, and we will not be able to take any questions. That's unfortunate. But thank you so much for the insightful presentation. And if listeners want to get in touch with you, we can help facilitate that.
Fantastic.
The next session is going to begin shortly. We will log off.
Okay. Thank you very much, everybody. Bye-bye.